Welcome everyone to our latest webinar in our Capital Insights series. Thank you for joining us today. These webinars are designed to provide information and have a discussion on topics related to funding your innovation startup, all in order to help entrepreneurs as they scale their business. Today's session focuses on when founders become funders. I'm Petra Stegman, VP of Educational Programs at Connect. Connect is a nonprofit organization created over 35 years ago. Since then, we continue to work with life science and high-tech entrepreneurs to help them grow and scale their companies through the various programs we offer. We're excited to have you with us today. We have a rock star panel lined up, all founders now turned to funders, so let's get started. It gives me great pleasure to introduce today's moderator, Mark Bowles. Mark is a serial entrepreneur who over the past 25 years has been a co-founder of 8 venture-backed tech and biotech startups in both Silicon Valley and San Diego. He has successfully raised 18 rounds of venture capital financing, totaling more than $250 million. He is an active angel investor in about a dozen San Diego companies and a board member of a variety of companies, universities, and nonprofits. Mark has been part of some successful financial exits for his startups, including the acquisition of EcoATM by Outerwall for $350 million. He is also co-founder, producer, and co-host of investment TV series VCs in a Van. Mark has over 100 patents granted and more pending. These innovations and products have won dozens of industry awards, including a TechCrunch Crunchy and CEA Small Business of the Year award. Mark grew up in Southeast Texas, arrived in Silicon Valley in 1987, and has been in San Diego since 2003. Welcome, Mark.
Start my video. Thanks, Petra. Welcome, everybody. I'm here with Jose Maracas and Joe Gatto. Let's jump right in. I'll let you guys introduce yourselves because I think you'll do a better job than me. Why don't we start with you, Jose?
Yeah, great to be here. And thanks for having me, Petra. Yeah, just quick introduction, similar to Mark. I came to San Diego around the same time in 2004. I'm originally from Mexico, but grew up in Southern California. Did my undergrad in UC Riverside in biochemistry, and then really fell in love with understanding the mechanisms of biology and did a PhD at the Salk Institute, looking at cancer mechanisms at the very controlled manner. But during grad school, I got this entrepreneurial bug and started to co-found a couple of companies and became a little bit of the entrepreneurial junkie since then. It's been now 20 plus years of doing that. And along the way, obviously gained quite a bit of experiences of things of what not to do and what to do properly as you go along. You never learn everything, but you gain enough knowledge to kind of figure things out over time. I was most recently CEO and founder of a company called NanoSelect Biomedical, which was spun out of UCSD, developing a microfluidic-based cell sorting platform. Was also a co-founder of a company called Arima Genomics, and most recently founder of Define Bioscience. I've been fractional CTO for Lynx Bio and advisor for a number of other companies. And about a couple of years ago, it's when I realized I really enjoy supporting and helping kind of the next generation and working on very early and neat technologies, particularly in the life science tools. And that's what got me excited to build Phase 2 Ventures, where I'm a managing partner and co-founder of that.
Okay. Joe, how about you?
Sure. So I'll keep it short here. Anyone interested in the long story can check out my LinkedIn page. So I was founder and CEO of a company called Starmine. We were famous for objectively measuring the performance of Wall Street analysts. We evolved to go on to develop predictive models for stocks, and money managers paid us nicely for this. So over 10 years, I raised 15 million angel and venture capital, interviewed 1,000 job candidates, hired 200, fired some, built a sales engine resulting in 33 million ARR, and sold this all to Thomson Reuters for 100 million. Then I started dabbling. I did some ad hoc angel investing. I also financed some solar projects, which exposed me to the clean tech industry a bit. In 2017, I started investing as an angel full-time, literally 50 hours a week, and I made about 50 investments through 2021. I ended up veering strongly toward biotech and sort of away from the tech, kind of more software and finance that I came from. One of my 2018 investments was DTX, a Connect company, and they had a huge exit not too long ago. In 2021, I raised and launched a seed folio, 20 million from about 50 LPs, with a little bit of my money in there too. So we're currently fully invested across 50 new companies, primarily in life sciences. We're not looking for any new companies, to possible disappointment of some of those on the call. But I'm currently focused on portfolio management, helping out our portfolio companies where I can. I'm on 5 boards, but I help across the portfolio. And in addition, I recently stepped in as CEO of one of these companies, kind of coming full circle.
All right. So let's talk about the journey from being an entrepreneur and getting into the capital side. My background, I actually started investing in startups when I was in Silicon Valley, and I was still working for a big company, Motorola Semiconductor, and I was in sales. And when I saw a really hot company that I was calling on, I got friends and family, and we put money in, and so I got a little experience doing that. And then I left and started my first company in the mid 90s. And but I've been investing in startups the whole time, including my own. But I didn't jump over to full-time, leaving being an operator and just full-time investing into startups until 6, 7, 8 years ago. Tell me about your journey of going from being an operator to going into the investing side of it, and how did you make those decisions?
Sure, I could go first, Mark. Yeah, so I'm still, I would say, in the early stages of joining kind of the VC side of the world. As an entrepreneur, I got a chance to meet with and learn from a lot of really great VCs, and also see the what works great and what doesn't work well along the way. And one of my first companies, Scholar Nexus, which became kind of like a bit of an incubator, and we used to kind of describe it as poor man's VC, because we would leverage SBIR grants to seed the startups and kind of move them forward. So I had kind of experience in putting those together. But as recently as we had a lot of exposure to new startups, a lot of entrepreneurs kind of coming up to me and my colleague Will Alenick, trying to get advice. What do I do? How do I do this? It became obvious that there's a huge gap in, especially regionally here in San Diego, of the number of VCs we can kind of connect them to, especially at the early stage, and in particularly in the life science tools and platform technologies that I focus on. And so kind of taking that experience from being an operator, seeing the gaps and seeing kind of where can I put value into some of these companies or add value, and really enjoying working with very bright early entrepreneurs. That's what kind of made me really kind of jump over and say, all right, we're going to do this. I could join another VC and kind of learn that, but I feel like there needs to be more here in San Diego regionally, and kind of just build something for the long term. So that's what I'm excited about, and it's exciting to see that the evolution that I hope kind of continues to progress in San Diego, to have more diverse set of VCs as well, coming from different angles. And so that's why I'm excited to be part of that and kind of build phase 2 from ground zero to where we are now.
That's a great thing for San Diego, Jose, and Joe, we'll let you go next, but it's worth noting, there's been no louder voice than Connect and Mike Kren and a bunch of others on, trying to get more local capital here and recycle that capital, entrepreneurs that make money,
Right.
recycling it. All three of us are people that have done that. But we were talking earlier before the call, we're the fifth biggest venture capital investment market in the country, the seventh biggest city, I believe. So we're punching above our weight in terms of the amount of capital that ends up here, but we're punching way below our weight for local capital that, is resident here. And so it's still a mystery to me why San Diego is upside down like that, why the money doesn't also want to come here and live in the beautiful city and invest. But thanks to guys like yourselves that are reinvesting the capital back in here, we'll just grow it from scratch. Joe, what was your pivotal moment for jumping from the operator side into the capital side?
Yeah, so it was initially it wasn't a jump. At first, it was a realization I was failing retirement, and some angel deals came my way. So as I mentioned, I started ad hoc. It wasn't until 2017 where I really kind of dove in. I made a conscious decision to let's do this full time as an angel, and then I started developing my processes, and I did pretty deep diligence on companies, and I'd write these 20-page deal memos that the fellow angels would like. And one day I showed a memo to a fellow angel, and he said, "This is amazing." He said he's invested in some big VC funds, and he doesn't get anything like that from his funds. He said, "I should start a venture fund." I said, "What? And you mean actually get paid for all my hard work?" And so the seed was planted, and no turning back.
All right. So, you've got scar tissue and lots of experience from your founder days. What part of that experience, how did that inform the way you go about doing your investing? That's for Joe.
Oh, so how does it inform how I do investing? Let's see. Uh, you mean on the how I evaluate companies, or how the founder experience kind of helps, or?
Yeah, all the above.
Okay.
You're instead of sweat equity, you're now buying the equity and
Right.
uh,
Okay.
you
Yeah.
know,
So yeah, so as a founder, I did a lot of hiring and firing, right? And well, a lot of hiring and a little bit of firing. And I think that experience helps evaluate CEOs and teams. The as far as how I mean, that's probably the biggest carryover. The having walked in those shoes, been on the other side of the table. I think that helps a lot. From operations, blocking and tackling, and different dimensions of that show up for different companies. Some of my companies are biotech, so building a sales force is not really relevant, right? They're hoping to sell one time to pharma. Whereas other companies, they do need sales, and they haven't been there, done that before, and I've built a sales team of 50 people. I can help them there. So just the operational experience in general, the understanding some different funding structures from being on the founder side of the table that some early entrepreneurs don't always understand. So just broadly, I'd say the operational experience.
Jose, what about you?
Yeah, I mean, being one step ahead, of these folks, it's helpful to one, to understand the psychology of some of these folks. Do I think they have what it takes to kind of go through, not just like, hey, I got this aha moment of this idea, or I developed this thing in the lab, but do they have the potential stamina? And you have to evaluate that from your experience. Somewhat you borrow that experience of like, do they have the psychology to kind of endure the fun and pain that comes with building a company over time? So my experience kind of helps to kind of maybe evaluate that in some way. And then, making sure to also connect the dots, maybe as Joe was mentioning on the commercial side, depending on what they're trying to do, can I lean into my experience to see if there's definitely potential of these things coming to fruition? Are technologies too early or a little too late? Are they a me too, or is the market going to come in 10, 20 years? And so those are all moving pieces, but I think that kind of helps to kind of stay grounded of your recent experience to how entrepreneurs are kind of trying to manage their technologies and applying that moving forward. So yeah, I try to leverage as many things as possible to you use your own mental matrix of things and try to apply it slightly different for different folks, right?
Yeah, so let's dig into that with a related question. For me, when I first started, you have this business simulator in your head that you develop and you're trying to run scenarios through it. Is this a good product? Is it a good market? Will it be sold? What are the channels? And you when you first start, your simulator is not very good and you come up with a lot of wrong answers. It's kind of like AI. The more data, the bigger the language model. And then as if you're at this for 15, 20, 25 years, your simulator gets pretty good where you can run scenarios through and, a better answer that's probably, more likely right pops out. And so for me, as an operator for so long, and then turn as an investor, I tended to focus on the team and does their simulator work like mine, and put scenarios through it, and does it pop out? Do we pop out a similar answer? And so that was the hard part about investing, becoming just an investor is I'm an operator and I wanted to go do the stuff myself. I wanted to help with the innovation. But you really can't get too much in the way. So how do you guys go about evaluating new companies? Do you focus mostly on team, technology, market, all the above? How does your simulator work when you go to invest? Start with you, Jose.
Yeah, it's a great question. I think for me, first, I have to get excited about the technology, right? So is this something cool? Is this something interesting? Then it's like, can this be productized, or can this be, a platform that can spit out different drugs? But first it has to, capture me. It's like, hey, this is cool. I haven't seen this, or this is a new twist, or, it's something interesting. If I don't have that, then I'm not so interested. But everything else is not as interesting. But that first captures me. And then I look at definitely the team, right? So does the team match, to the potential of the platform, the technology that people are building, and then that's definitely very key to spend. After I think something is nice and interesting, then I feel like, okay, now I can spend time, because when you want to evaluate people, it's not a pitch deck that you just look at, or it's not a paper that you read. It's getting to know individuals and having conversations with them, having a coffee chat, and then you get to kind of really know those individuals and the folks that they've kind of brought around on the table. So the team is by far critical, right, to then move forward with that. Do they have the capability of doing that? And so that's usually the way it's like, do you pass on the technology? Then do you pass as human beings, to make this work? Can you adapt to things? The way, as you mentioned, Mark, do they think through and kind of have a good understanding of how things could fail? What are the weakest points of your models? What are the weakest points of your technology? And do you have ideas to kind of mitigate those things to move forward? And what we're basically doing is trying to reduce the highest risk, right? And then kind of checking those off. And then, but it's still, we still have to kind of live with a good amount of risk. I mean, that's why we're investing, right? To, with this investment, help to address the next major risk item that's going to make this successful. But yeah, it's technology is a cool, and the individuals, are they not only smart enough, but do they have also the emotional intelligence to build a team, and then do they also have the charisma to fundraise and to tell a story, right? And not everybody has all those pieces that they're, together.
Okay, Joe.
Sure. So, I certainly agree with Jose. Step one is I've got to care. And if I can't care about they're going to solve this problem. If I don't care about solving that problem, I'm not going to have the energy to do all the due diligence. This could be the biggest possible opportunity in the world, but if I don't care, I'm not going to get started. So, I could, on the one hand, I look what you and Jose and everyone else looks at is team, product market fit, financial prospects. One thing I do that's somewhat formal is I boil that information into an evaluation model. So I calculate a probability weighted multiple of invested capital, where I quantify or estimate to the best I can probability of success, multiply that by the exit size if they are successful, multiply that by 1 minus future dilution, often overlooked, and divide by the current post-money valuation. That gives me a probability weighted multiple invested capital, and I'm looking for a probability weighted multiple invested capital of at least 10x. So that's like a 1 in 10 chance of 100x return after dilution. And kind of picking up on your simulator comment, the biggest evolution of my simulator, right? So that's a model. It's logical. It's hard to argue with that, but garbage in, garbage out, right? So where has my simulator been getting right and wrong? My biggest evolution has been on the team side, as you pointed out, as being critical. And maybe I'm a little slower than you and others on the uptake there. So I've been good at weeding. I haven't had a problem with like jerks ending up as CEOs or integrity. My biggest failure mode is as an investor has been investing in a technical founder who doesn't present as a CEO. Because I was a successful first-time founder, I tended to cut them too much slack, be too lenient there. And a lot of my current portfolio management now is cleaning up teams, hiring a new CEO or moving a CEO to a CSO role or hiring a COO to complement the CEO. I mean, and we can touch on this, more later if it makes sense. But so, that's a little bit of a thumb sketch about how I evaluate companies.
Okay. This is always it's always tough to say no to, you don't invest in everybody you see, right? And so you've tries to raise money and been told no many times, I'm sure. What's the most humane way to do that? For me, I meet with a lot of companies. You guys see a lot of pitches, and a lot of them aren't there. A lot of them aren't there yet. So I usually take sort of a coaching position because I love entrepreneurs. I love entrepreneurship. I want to see everybody successful out there. And the best thing I can do is tell you that and tell you the specifics of why you're not there and coach you on how to fix that. That's not always how I got it when I was trying to raise money. You get ghosted or insulted at worst, maybe. But how do you guys go saying no? What do you think the most humane way to do that is? Joe, you start with you.
I've got my policy is never ghost anyone, and it's become a thing. I just can't I can't stand it personally. Right now I'm in the mode, as I mentioned, I'm not looking for new companies, so I don't even get my head into them. I've got almost an autoresponder. I type a few characters that said, sorry, seed folio is fully committed, fund 2 and fund 3 is probably a couple years away. Before that, so now if I'm in kind of search mode for companies, my other autoresponder is this is not a fit. And so I'm happy to be short if it's just not on target. Some people haven't done their homework and they bring me a completely out of scope idea, and I can be short. I get 20 to 30 inbounds a day, and I just can't do thoughtful replies to all of them. But once they get into my system, if they catch my interest and I spend time on the deck, and if I go to what I'll often do, sometimes the deck will turn me off, but if I like the deck, I'm pretty quick to send my calendar and say, hey, let's jump on a 45-minute call. I'd like to learn more. If I've done that, if I go to that call, then I'll always provide feedback. I won't just go silent. And it's often of the form of, the evaluation's just out of line for where I think I could get this done. Come back to me if you change your mind on that. Or I think you're a great technical founder. I'd really like to see operational experience, rounding out the team. Come back to me when you get that. So I try to frame it as a come back to me if you meet X, Y, or Z, or I thought I was interested, but I'm not because of this reason. So I try to be as constructive as I can. And in some cases, it's been, it has had some really great positive benefits. And in other cases, they think you're a stupid jerk for giving them feedback. So it's tough.
Okay. Before we move to Jose, I'll ask a related question. Jose, you can answer both. Is there any advice you wish an investor would have given you when you were a founder back in the day? Beyond what you just said, is there any other advice that you wish you would have been given?
Yeah, that's a great question. I think taking some of this advice and similar to you, Mark and Joe, try to give as much constructive feedback to people that I do talk to. As Joe mentioned, sometimes we just get inbound of things that just clearly are out of our topic or field. But yeah, when we do talk to folks, either try to be as transparent as possible of like, hey, this is kind of outside, but I know somebody that might be interested, or here's things that you should maybe work on or include or come back with. And when I look back in my early days, I just wished I sometimes would come back with just like, I presented my story a little bit differently, but it's like, no, come back with some either get additional traction, don't slow down on your development, whatever you're doing, and then come back with like, hey, I made progress, or I addressed your thing and I did this additional thing. When I talk to founders now and I see that, like, to me, it's just like, hey, you not only like heard me and you did that and addressed some of the points you that I mentioned, but you even went beyond that, right? And that to me just kind of shows great traction. So when I was, very green, I wish I kind of was able to do that a little bit more nimble. And then also, understanding that we're all in different phases of deals or funds, right? Like Joe's just completed, and you try to email Joe and it's like, oh, I never heard from him, or or never got anywhere. But understanding also that we're all in different phases, and I also try to be transparent with certain folks. If I'm in the middle of a diligence, where I like, we need to dive very deep in some of the technical things. So it takes a lot of time, and I try to be transparent. Hey, I'm doing it. I'm on a deal now, so get back in 2-3 weeks and try to find some additional time. And some people do, and some people don't, right? So so understanding those waves of activities that VCs have from funds, in between funds, and then in between deals, not being afraid to politely, reach back and try to find the right timing that matches.
Okay. So go ahead.
Joe, do you want me to chime in on some
Yeah,
advice for founders? Because so I'll frame it as like what advice I give them today, and it's a recurring theme so many times. So I think maybe it may be relevant to some folks on this call. And most companies are started by technical founders, and that's great. And technical competence is almost always necessary, but it is almost never sufficient for success. So a blind spot of many technical founders is the marketing side. And they often assume if we build it, they will buy it. This is cool, isn't it? So my advice is go talk to 50 potential customers, someone who could write a check before you build your product, not after it, but before. And people, so, and walk away from those calls with either an LOI, oh, I love it, here, right, count me in when you build it, or feedback on what it would take them to buy, right? What's not resonating. And you could bring them a straw man, a PowerPoint presentation, go read Lean Startup for ways to fake it. That's fake the product until you can get some feedback. And the other one is to be honest and know your limitations. If you're not a natural salesman, you may be better off bringing in a CEO who is at least relatively strong on the technology, but who can really sell, because you need to sell to investors, to customers and to potential hires. And companies just don't grow without salesmanship. Technology is key, but it's not enough. So, look yourself in the mirror, and if that's not you, figure out a way to augment that.
Yeah, absolutely. Storytelling is how humans have communicated since we were grunting around the fire in the cave, and it's the oldest and best technology for. You have to
Yeah,
evoke emotion in the audience before there's any action, and so if you're not that person, that's fine. Bring that person on.
Yeah, I would say, especially in the science field and the biotech, I mean, that's just kind of maybe a tendency of, being a scientist. I think most scientists are slightly more introvert than probably the normal population, right? So having a little bit more of that, that's what I mentioned earlier, having that charisma and the ability to sell is very, very important. So yeah, very good points, Joe.
Yeah. We touched on this a little earlier, but I want to talk about how you try to add value to companies. I expressed my difficulty earlier as I made the transition from just, being an operator and done that for 20 plus years to just investing and, looking at the teams, and you kind of want to jump in there and throw a shoulder to every wheel and help out. But, it's kind of like I have 3 sons. It's kind of like raising your kids. They're going to have to fall down and hurt themselves sometimes, but you want to keep them between the ditches, and at least on the highway, right? And so that was always a struggle for me, because if you see something going wrong, a mistake you've made before, a mistake you've avoided, you want to help. But if that's a daily thing, then it's probably not healthy, right? So how do you balance? How do you try to add value without hugging the hard?
I can jump in. So as I mentioned, for one company, I stepped in as CEO. That's obviously not scalable and not what you're that's the kind of the opposite of what you're talking about here. So for me, I got a big portfolio, like 50 companies, and so I'm on about 5 boards and a board observer of one. And where I'm on boards, I'm more in, I've got a seat at the table, and I help with strategy, help make big decisions, thinking through approaches to financing, possibly indication prioritization, et cetera. So some big picture stuff. But across my portfolio, frankly, where I do the most time is introductions. I'm a matchmaker. So introductions primarily to money and partners. So I used to go to 6 conferences, like the biotech conferences, like Biotech Showcase, et cetera, to meet new startups. I still go to those conferences now, but instead of meeting new startups, I'm trying to meet investors, to Series A investors, to introduce my companies to. So I built a database where I've got 1 page on each of my companies, including founder LinkedIn and my story about why I like them and their pitch decks. And that's my way of communicating with the VCs, and they tend to like that. I met with one of my companies yesterday who's ready for a new raise, and after the call, I connected them to 5 different VCs who specialize in drug device combinations, which is a bit rare of a breed, so that that they'd find this company relevant. And yeah, anyway, so it's really basically comes down to lots of matchmaking is how I spend a lot of the time. And as one famous angel investor said, you got to keep your noses in, but your fingers out. So pay attention, stay attuned to how you can help, but don't try to take over the reins.
Jose?
Yeah, I would add definitely. I think that's probably the most important thing is to help with the matchmaking in the later stage of fundraising, especially in the current environment. I think it's even more important. But also in the earlier stages, matchmaking with team members, right? So how do you find the right folks that will complement the founders? So I think that, being out and networking on behalf of your portfolio is very important, kind of keeping track of where people might be migrating, or seeing a up and coming great marketing person or salesperson that the more technical group might not be familiar with, how to bring them in. And I've seen mistakes where they will bring in a very, very senior commercial person, and it's just not the right match for the early stage or the stage of the company. So helping in those from the fundraising and connecting people, and then definitely try not to get in and micromanage, because I think, as you mentioned, Mark, you could, you want them to develop on their own. But if there is a need to step in temporarily or help them out on something, that's we try to do that on a case by case basis.
Okay. We're going to shift gears here into a slightly different topic, but related. San Diego ecosystem. So if the audience has any questions about this past segment, go ahead and post those now. We're going to circle back for 15, 20 minutes Q&A at the end. But so as the San Diego ecosystem, we talked a little bit about it in the beginning, it's, continues to evolve. It's always evolving. You guys are making a direct impact with, having founded companies, but now being on the capital side of it. From your perspective, what are the next steps for the region to foster and scale up so we have local capital that matches our place in the market? Joe, why don't you go first?
So, I don't know how to give advice to a region. So I'm not going to have a great answer here. I don't keep exact tabs on it, but I'd say roughly a third of our investments are in San Diego, a third are like the Bay Area, and a third are the rest of the country, or in some cases a little bit outside. So we're not a regionally focused fund per se. We end up kind of overrepresenting San Diego and Southern California just because there's ease of deal flow and it's how networks evolve. But Connect's doing a great job here. You mentioned earlier that you're kind of surprised that there's not more going on. I'm seeing a lot of uptick. I know of a new fund that's getting started that'll make a big splash when they announce. Mike Kren from Connect went over to Prebis and raised a fund. So I think keep following Connect's lead, and I'm optimistic about the trajectory. It seems really positive.
Was Dave?
Yeah, I think for me, what I've seen is building out an LP ecosystem, right? So it's kind of starts all, where does the money come from, right? And building out a VC, having to travel to, outside of outside of San Diego into some, the Bay Area or other areas to go fundraise, where, we should have some of that network here. Right. So I think, and part of that's probably just education and into our ecosystem, that, how one does that. When we talk to folks in the Bay Area, it's kind of like, this is normal, right? This is something that high net worth individuals or institutions, just kind of see that deal flow, and we just don't have that reputation yet. I think we're getting there. We're building that up. So I think that's and it's all cycle, right? As we support more of that innovation and bring in more VC dollars to the startups, we should expect more exits that then build, more folks able to invest, and so we got to just kind of continue to support that. So if we have success with our startups, and I don't mean our portfolio, but in general, San Diego, but also build a network and an ecosystem that just makes it easy to then invest back. I think that's probably the next stage, in my opinion.
Yeah. Yeah, when I got here in 2003, after doing several companies in the Bay Area and raising a lot of money there, I got here and there wasn't a lot of local capital. And so I just got on a plane and went back to the same people that I had raised from before. It's changed a little bit since then, but I said in the beginning, I think it's a mystery why there's not more local capital here. I think one of the explanations you touched on is that it's a flywheel, and it's successful entrepreneurs that make millions then start recycling it. And I think we're getting there. And I think, founders are reinvesting in San Diego. But I just think it takes a while to get that flywheel going. And I think the other explanation might be that we're so close to Silicon Valley, that they think they cover it. And so, if you're going to raise a new fund, put it there, and you can have Silicon Valley and San Diego and LA at the same time, right? So I don't know, still a mystery, and I appreciate guys like you helping solve it. Okay, any last advice you want to give founders on the call about anything, founding companies, about raising capital. Any last words on that?
I mean, just more encouragement and be creative in these days when maybe money isn't as abundant as it was maybe a couple of years ago. And I normally would also suggest, definitely go into the SBIRs, but I'm sure that's going to be a little bit of a challenge next couple of years. But stay creative and be strategic.
So,
Nothing further to add that I didn't already comment on.
I have one thing, and I think you guys will relate to this. One of the things that my simulator developed after about 4 startups and some painful deaths was thinking through the exit. One of the biggest aphrodisiacs for me when I'm looking at a company is when the founder can articulate 2 or 3 clear paths all the way through the exit, not just excited about the technology or the product or the market. But if we pull this off, who's going to care? These big companies, because of their roadmap and this, and their PE ratios are this and that, and this is where we would fit and make them a bigger company, and why their shareholders would be excited about acquiring it and so forth. That to me is closing the loop on what I care about. If I'm going to invest, now it's an investment vehicle. And if the founders aren't driving for the exit and haven't thought about it, then who is? And so I think the thing that I generally share with companies when I see them is, look, think through your exit strategy and engineer your exit from today on. And there's a lot of steps you can do that if you're thinking about it, things that are knowable, you should know them, and you should engineer that from the beginning. So that would be my last piece of advice. Okay, Peter, I think we are ready to open it up for Q&A. So let's go down and look at the list here. Okay. And guys, you can help with this too, Joe and Jose.
Sure. So, I see John Harmon ask a question. He says, as founders, you all experience the extreme inefficiency of our industry. Now, as funders, do you push your companies to operate efficiently, or do you accept all of the inefficiency, or simply as a cost of doing business? As I mentioned, key to my formula is, 1 minus future dilution. And I want to know how much you're going to spend to get from here to, milestone, the big next milestone. We can do that exercise till, the Series A and the Series B. I can't see all the way to the future. And, the exit matters a lot, as Mark says. So it's not a matter of accepting it. It's, if someone comes in and says, well, we got this rock star CEO and at $500,000 a year at seed stage, they're just not spending stuff efficiently. If they're building a platform and they're boiling the ocean, it's not going to be capital efficient for us. If they're, they're therapeutic modalities like, autologous cell therapies, they're just fundamentally slow, long, time consuming, expensive. They're not going to be there. So I consider strongly the capital efficiency or not up front when we're evaluating, and then try to, if I'm get involved with the company, I try to keep them on track with that.
Okay.
Yeah,
Jose?
I think that's hugely important.
Yeah. Jose, are there any other questions here in the?
Yeah, there's one about AI. What are your thoughts about the use of AI in drug discovery? Where is AI going to be most helpful? I don't have a crystal ball around that, but definitely is something that we definitely saw a huge uptick in. Everything has AI in it. And using AI for antibody discovery or creating new therapeutics, I think AI is definitely going to help. But if your whole play is only AI, you don't have some kind of other edge of kind of creating a moat around the data or the modality of how you test things. I think that's still very, very important. So it's kind of, you still have the fundamentals, and then does AI help you address those things to further that? I think that's important. But if it's just AI, and I'm not a pure AI guy. I'm usually not, I'm not going to be very interested about that, right? Because, how do you validate it? How are you going to be different? How is ChatGPT not going to outdo you in the next release or two? So, how do you create a moat around you so that no matter how AI moves forward, you're going to have an advantage around that, and AI will help drive that. I think that's very, very important. But then I also see uses of AI in just not as the key thing of the technology, but definitely supporting that, right? So in company defined bioscience, it's media growth media company, it's like using AI to develop new formulations. Fantastic, right? But that's not AI is not the key driving force. So it's going to be something that we see in a great deal of things. I think it's important. It even goes back to Joe's maybe previous question. How can you help inefficiencies? Maybe AI is going to help address some of those inefficiencies, ideally.
Yeah, I'll add. So, I mean, the question was specific to drug discovery, and one of our companies, Ordeos, they're doing it. There's a lot of window dressing with AI. There's a lot of wrapping PowerPoint decks in it. Like, if we went back 30 years, wrapping the web and internet around things, because it's the sizzle of the day. Ordeos is doing true de novo molecule discovery. A lot of the AI companies are doing optimization. And that's, it's a neat trick, but at the end of the day, you end up with candidates, and you still got to run them through in cellulo, in vivo, in vitro, in vivo assays. You still got to talk to regulators. You still got to get patients and recruit them. So it can be super helpful at the front end, and they're demonstrating that with generating some great candidates. But there's lots of ways to discover drugs, and it's certainly a neat addition to the pipeline.
Okay. There's one question here that I'll take, and maybe you guys can add to it if I don't cover it. There are plenty of ideal pitch deck content lists, blah, blah, blah. What do we believe is, core deck looks like? For me, it's I think the ideal deck is a story. There's Guy Kawasaki in the 10, so I think it's okay to follow the formulas, to set it up. But again, it's storytelling, and it's not just what's in the deck. What I want to see demonstrated is that the founder that's presenting is really, really nimble with everything that's knowable about this equation at that moment in time, right? For their business. I want to see a geek, a wonk, a nerd, that they've thought through all of the business simulator. They've run every piece of it. Some of it's not knowable. Most of it's not knowable at a seed round, but that you have attempted to think about every possible thing, and that you don't claim that you know stuff that you don't know. No, we don't know that yet, but we'll discover it by doing these experiments and these market tests and these, whatever. So, again, the biggest, we all know, everybody has a pretty good radar when somebody is talking to us and we know that they know what they're talking about cold. And it's almost a pheromone that's in the air. We all have that sense that, man, this person really knows that. I don't really want to invest in something until I'm talking to that founder who is really excited about it and is just reeking this. I know everything is knowable, and I don't know these things, and here's how we figure it out. And so that, one of the things in a deck that I think is powerful is when the presenter starts off and says, you, Mr. Investor, are going to love this investment because of these 3 things or these 4 things. And they challenge you, like, I'm going to love it because of, and then, put those 4 things, 3 things, whatever it is that you think are the real value of it. The market is massive, and we have this, whatever it is. Team might be one of them, but then you back that up for the next 10 slides, and then you summarize it with that, and you make me believe those 3 things or 4 things. Yeah, they probably got that right. Then I might take the next meeting and the next one, right? Know what you're talking about and know what you don't know and present it convincingly. So anyway, that's my speech on that. You guys have anything to add?
Nope. Yeah, I agree on that part, and I think it done. I agree with you 100%. I do pretty well on that part. What I find is that I get in love with those. Oh my God, they know everything on this topic, and that's not enough for building a business, right? And so that's why tying that to my point that I made earlier.
Yeah. Okay.
There's one from another one from John Harmon. I can take. He said, Joe, you spoke of getting market feedback to determine product market fit, but in our industry, which is life science, it looks like we are notoriously bad at knowing what we really need. You're generalizing to the industry. Any advice on how we get more Steve Jobs? You won't know it until I make it approach. No, I say is you don't. Steve Jobs was great, but he's doing consumer tech that, people say, ooh, that's cool. I can fit songs in my pocket. They didn't know they wanted to do that. That's great. But you're in life sciences. People want to increase revenue and decrease costs. So talk to them about their problems and see how your lab automation can help with that. Go to their problems. One of your companies, I just checked your LinkedIn, a lab automation company, I was an investor in, and it's a classic lack of product market fit. Whiz bang technology, but who cared? And they raised and burned a lot of money, because the technology wasn't enough and they didn't have that market fit. So I'll reiterate, don't play Steve Jobs. Be dumb and stupid about it. Go out and talk to people about what do they need. So if the people who can write your check, what would it take to get you to write that check? That's my answer on that.
Okay.
I totally agree. And just to add to that, I mean, you do want to have some kind of intuition, obviously, of kind of how these things, but if you don't truly can crystallize the problem, then you're not, maybe making that connection as clear as you may think you are.
Okay. Someone asked here, besides the risk of dilution Joe Gatto mentioned earlier, what is the minimum equity percentage you would require for an investment? I think there's a sort of a generic industry answer, but I'll let you guys answer.
My answer is I'm not trying to maximize percent ownership. I'm trying to maximize return on investment. And especially playing with a small check means valuation matters more than than anything else. And valuation and future dilution and all the things I put in the formula. So it's not. If I raise another fund with more money, I'll still look for great deals, and I'll just end up with a larger percentage of the company. So it's not, I don't optimize for percentage of the company, and I know that's atypical. Larger VCs will tell you they've got their rule. They want to end up with Arch, whether we invest 5 million or 50 million, we're going to have 51% of your company, after the round. And that's great if you can get away with that. We're not at Arch level yet, so come back to us in a couple of years.
Yeah, I agree. I mean, we play in the pre-seed seed stage, so we're not totally optimizing for that. Whereas, typical, and there are formulas, people typically give up 20 to 30% as a whole deal, on each stage. So I'm sure people can look back at, what is on average is giving up, but for us on the pre-seed and seed stage, we're looking at, early enough deals that doesn't really take into account. It's more of, as Joe mentioned, is the valuation right? Does it match the level of risk that I'm taking early on?
Yeah, I think one thing that a lot of founders don't, or new founders don't realize, pre-seed and seed money are the most likely to get abused as time goes on, because new money always, the he who has the gold makes the rules, and new money doesn't necessarily respect the money that came before. And so, one of the challenges of pre-seed seed investments are you might get whacked later when you took the biggest risk and, believed in it first. And so treat your pre-seed and seed investors well and protect them as the new rounds come along, because it's often the case they just get diluted and whacked. It's happened to me
Yeah.
a lot.
And to add to that, sometimes it's not even something to discuss much if you do it through safe rounds or other, you can put caps and things like that, but that also makes it easy to, have those discussions without diving into full valuations.
Yeah. Petra, do we have time for one more question, or should we wrap it up there?
Yeah, I think we've got 1 or 2 minutes.
Okay.
I can
Take
do a
your
quick
pick.
one on, you said, do you trust academics to run drug development, meaning a clinical stage company? I'll take a stab at that one. I don't often see academics running clinical stage companies, so there may be a really unique fact pattern here. But in case there's an academic, entrepreneurs on the call, I've gotten to a point of being burned. The company I stepped into is an academic at UCSD, and couldn't actually, great guy, couldn't actually get it off the ground. And that's one of the reasons I realized I needed a CEO. Tried to hire one that had some missteps there. Ended up me taking the role was most logical. But if I were looking for companies today, if I'm talking to an academic, I'm really excited because they often do really cool stuff, but I will not fund the company until they find, I'm not going to build it again, until they find a CEO, and that's not just their postdoc, Lackey, but until they find a CEO, and that, I mean, at least 50% time, and somebody who's been there, done that, at least as a CEO or COO before. So I may not have answered the question exactly, but maybe that had some relevance for others on the call.
Yeah. Okay. One last thing here. Somebody, I think I confused somebody with my exit discussion. Yeah, acquisitions are how companies exit. I mean, with the rare exception of, IPOs and well, there's other ways to exit, where you don't return any money to the investors, and that's the majority of cases, right? And so, but yeah, acquisitions are how most of it happens. And again, the point was, if of talking about engineering it, is that if there's an ecosystem that you live in, and if you pull off the business plan that you're presenting to the investor and do exactly what's in your deck, who in that ecosystem is going to care enough to buy you and where you fit? And some of that stuff is knowable, at least the ecosystem and how they value stuff, and when they last bought somebody, and how much they pay, and what the PE ratios are, and who their executives are, and what the roadmaps look like. This is all knowable stuff today, and you should know it, and engineer that exit. Anyway, that was the point of that.
I agree with that. Maybe just to add, as you then build your different stages of fundraising, it might be important to add certain VCs that exit or companies through certain strategics, so you kind of continue to increase your chances of how what's the path to getting there.
Yeah.
Yeah, you either have to
Okay.
get acquired or you have to build a sales force. And and people say acquisition or IPO. Well, we had a company who invested in 5 years ago. They IPO'd recently, but it's not an exit. It's a financing event, and
Right.
that is just a way to raise money so that they can finish their phase 2 trial. At the end of the phase 2 trial, if the data is as good as we think it'll be, they might raise more money at a higher valuation and go to phase 3 and get it approved and get acquired, or they might get acquired then. But an IPO is not mutually exclusive from an acquisition. It's often a step along the way.
Yeah, exactly. Okay, I think we're out of time, Petra.
Yeah, exactly. I think we've covered a lot of turf, and definitely want to thank you, Mark and Joe and Jose, for all your insight and shared lessons that you've shared with our viewers here today. One of the things I did want to, before we drop off, is that some of the questions are very relevant. They're very basic questions, and I want to encourage all those on the call. You will be receiving the recording to this one, and we have 7 other ones where some of those very basic questions on venture funding, alternative funding routes, etc., the importance of a funding strategy, have been addressed. So we'll put that into the email that'll go out to you, and so definitely have a look at them. And hopefully they will be of value to you as you build your companies. So Mark, Jose, and Joe, thank you so very much for today. And thank you to everybody who joined us on the call. I hope you found, this webinar series to be insightful for the companies that you're building. As I said, this webinar is recorded and will be made available to everyone. And we hope we'll see you at some future sessions on Capital Insights. So wishing everybody a great day wherever they may be. Thank you so much.
Thanks, Petra.
Thanks, Jose.
Thank you, everyone. Bye-bye.
Bye-bye.